Boom, bam, damn, stocks erase earlier gains as recession concerns weigh on traders. My God, like, look at this. Inflation came in at 0.1% in March, 5% from a year ago. Clearly, they're going to be slowing down the rate hikes. We're probably coming to the end of that cycle, and yet the Fed bursts the damn bubble. They don't want this market going up. They said, hey, the latter half of 2023, likely recession. Mild recession, but likely recession. And the market just took that as, oh, damn. We thought the latter half of 2023 was going to be better for the market, and everyone's selling off based on that news. So, yeah, I don't know what to say about that, but we're going to break down where I think you're going to get rich in this market, what I'm focused on, and it has a lot to do with the Canadian market. Even if you live in the US, I'm going to tell you right now why you're going to get rich buying Canadian stocks, and it's going to encompass a lot in this video, so consider hitting that like button. Firstly, I was playing VR last night, and I found it absolutely hilarious thanks to the metaverse, the Mark Zuckerberg giving me this really weird reality thanks to the likes of Graham Stephan and everyone and their grandmother talking about the doomsday to the US dollar because OPEC and all these big oil beasts in Russia and Brazil, they're all turning away from using the US dollar. They're probably going to want to use the yuan or some other native currency to buy oil and other things, which people thought was the destruction of the US dollar, which it is pulling back. But I think people are missing the point here. They think the US dollar is just going to keep collapsing, and it's been falling off since the beginning of the year. But this is a healthy pullback, considering if you look at the all-time value of the US dollar, it's actually sitting at 20-year ago highs still. It's not like it has more value on the global market than it did for the last 20 years. So I don't understand why everyone's just like, oh, it's the end of the world, the dollar's collapsed. Like, literally, people are so dumb and they don't even look at the actual value of it. This is like a bit of a drop. I don't think we're going to see major drops, but hell, if it keeps dropping, just another reason to get rich in the Canadian markets, because what we're going to see is the US dollar drops, it converts better to Canadian dollars, and we can see as the dollar rallied, it really ate up the value of the Canadian buck by 10%. So if you bought just US dollars as a Canadian back in the midst of 2021, you would have made 10% on the conversion, because you could have bought Canadian dollars back for 10%, like 10% more Canadian dollars. We can see over the last month, as the US dollar drops, that means Canadian dollars buy more US dollars. So if you're a US citizen, think about it. You're buying some Canadian assets and the Canadian dollar gains more value to the US dollar. Oh my God, you're making extra percentage returns on your Canadian assets. I hope that makes sense. I know it's confusing as hell, but it's just the reality of international currency exchange, baby. But Bank of Canada is going to stay on pause. They paused a lot earlier than the US. The US is likely to finish with one more rate hike, but the Bank of Canada stays paused. You know, they paused back in March. They ain't going to raise them anymore. Our inflation is much lower than the US is right now, so they ain't going to be doing too much overall, which is good for sustaining the Canadian economy, considering how insanely expensive real estate is, the cooling period that we're seeing in real estate. But are we going to see a real estate bust? I'm going to discuss that in a moment. But why would you get rich in Canada in a market environment like this? Why are recessions good for Canada? Well, firstly, our banks survived most of the recessionary environment, literally all. 2008, skimmed through that, no problem, no dividend cuts. Who knows? You know, this could be a different time. But the reason Canada is a place you want to invest in during recessionary periods is we're the most commodity rich, at least one of the top 3 most commodity rich places on the planet. Yes, Canada, I know, hard to wrap your head around. We got a lot of resources here, baby. Oil is one of those. And thanks to OPEC, you know, they're raising the value of oil here, cutting barrels back by over 1 million for the year, whatever. So if oil goes up, Canada's going to benefit from this. If gold and silver go up, Canada is going to benefit this. We have some of the largest gold companies on the entire planet. You know, all these materials, as they kind of gain in value, you're going to see it benefit the broader Canadian markets. I promise you that. So in recessionary periods, this is why you want to put some money in Canada, especially if the US dollar is going to start losing value from these wicked peaks we've seen over the last couple of years. The other reason that Canadians are going to get really benefited here, now again, not talking about real estate, but as an economy as a whole, we are one of the fastest growing nations by a percentage of population. And when I mean percentage of population, I mean, you know, if we've got, God knows, 30 or 40 million people, how many new people are coming in versus how many we have? Compared to India, compared to the US, we're growing faster than they are. And Ontario plans to double its skilled immigrant intake. Ontario is investing $25 million more over the next 3 years on top of the $15 million over the 3 years that was announced in the budget of 2022 to double Ontario's skilled immigrant intake. The investment will work to address the labor shortage and promote economic growth in the province. Our government is ready to welcome more skilled newcomers to Ontario to help build the highways, transit, schools, homes, and hospitals our growing population needs as we continue to tackle historic labor shortages. We're doing everything we can to ensure we have the workforce to help build Ontario. It's all hands on deck, baby. Let's go. And, you know, as a monopolistic society where we only have few banks that are highly regulated, we only have few monopolistic utility companies, we basically only have few major companies in every, even tech companies. I mean, Shopify, Constellation Software. Brands is a US alcohol company that bought Canopy that tanked miserably on that investment. But nonetheless, I think this is going to benefit these monopolies. This is why our telecom and our banks and everyone just continues to post growth and crazy amount of user growth and all this stuff. So it makes it an easy investment where you know there's always going to be at least somebody to sell products to, right? So how do we invest in the Canadian economy if you're a newcomer? Currently, I've only got one investment. We'll discuss it in a moment, but there's the Vanguard FTSE Canadian Index ETF. I'm going to start proponently adding this to my portfolio as the broad exposure to the rest of the Canadian economy, which is actually doing pretty well from the all-time high. It's only down 7%, outpacing the S&P 500. You're getting a 3.2% dividend yield right now. Expense ratios are excessively low. And just to show you the top 10 holdings, again, this is your best broad-based exposure, very similar to the S&P 500 in the US, with the largest companies weighted by market cap from Royal Bank, Toronto Dominion, Enbridge, Canadian Pacific Railways. You got your railways, you got Shopify in here, of course. And if you take a look at kind of the breakdown, I think that was back up here, you can see financials and energies make up the two biggest proponents. Now, if financials do get hit pretty heavy, yeah, we could see some softening in the broader index, but we're cushioned by energy, some of the other, sectors here as well, basic materials, industrials, etc. So I think financials, again, considering how resilient the Canadian financials have been, I'm willing to bet on it through this recessionary period as well, because I just don't think it is going to be as hard hitting as the 2008 one was. Now, my personal favorite, got 150 grand in this one, obviously VDY, and this just really concentrates those large cap Canadian dividend stocks. So this one, is doing very well over the last year. Let's take a look from peak to trough here. Is it doing worse? Is it doing better? Being a little more concentrated, you're seeing a little more volatility, down 10%, more in line, but still performing better than the S&P because the dividend yield's much higher at 4.52%. Baby, you gotta love that. A little higher expense ratio nonetheless. But scrolling down again, you guys know this. I talk about this endlessly. It's one of my favorite investments of all time here. Royal Bank, Toronto Dominion make up 25% of the ETF. Enbridge, Bank of Nova Scotia, you got things like Suncor, a little bit more energy centric. So again, if you take a look at the exposure here, you got 56% financials, 26% energy. So presuming energy does better, this ETF is going to benefit from those energy boosts in profit from Suncor, Enbridge, those kind of companies, right? And then finally, we do have things like the iShares S&P TSX Composite High Dividend Yield Index. This one I'm kind of on the edge with, but I think you could add it with VDY just for some diversification, because VCE, VDY, very concentrated energy financials, whereas this guy gives you a little more broader diversification, so it could be a little cherry on top of the cake for something that pays a bit of a higher dividend yield. And just taking a look in this real quick, you can see here the dividend yield's 4.68%, the distribution yield or the 12-month trailing is 4.75%. Same rough expense ratio as VDY. I think it's this, around 0.2%. Not complaining, but the top weighted holdings, 10% of the entire ETF is in TELUS and Bell. Two of the most incredible dividend stocks Canada has to offer next to TC Energy, Enbridge, Canadian Natural Resources. You're kind of getting a good exposure and a more broad diversification to things like Fortis Utilities, there's Suncor, and again, those banking sectors, right? Seeing the exposure breakdown, energy at 30%, financials at 30%, utilities at 17%. Typically, the more diversified you get, the less performance you're going to have, because again, taking a look at the broad view from peak to trough, is it more stable? Nah, it's about falling in line with VDY. So the broader index VCE has been doing a bit better here, but it's not as good over the 5-year basis. 26% gain on the cap side of it, whereas VCE is up about 37% and VDY is up 32%. But again, if you're just buying this for income, these are monthly paying ETFs for VDY and XEI. And I just think if you're converting currency into these ETFs, if you're in the US right now, you're going to see a benefit and a boost if you think the US dollar is going to continue to fall off. So obviously, most of my new money at this point is just going to be going in the Canadian economy, because it's what literally makes the most sense in the current market environment. And I'd love to know what you think about that in the comments section below.